Hi, class. Hopefully, this lecture finds you healthy. We're in the middle of the coronavirus, North Texas, and all my classes are online. And I'm recording this video on equity, preparing for our next exam, which is in just a couple of weeks, the last exam of the semester. So again, I'm recording these lectures to supplement, not replace the Pearson lectures. The Pearson lectures are excellent, except I guess at least you get a human face with this one at the beginning of the lecture, a familiar face since we were together earlier in the year. So purpose of these lectures, very focused on the things that you need to know for the exam. So these lectures are good to listen to. I will work problems, and I'll ask you as we work the problems. I'll pause the video. I mean, I'll ask you to, I'm not going to pause. You guys can pause the video, work the problem on yourself, restart it, and then see how it goes. And so this is how we did things in class. And so hopefully it'll be very similar to that. And again, let's finish this semester strong. I mean, you guys were so engaged, you did great on the last exam, and you can bring it home with a great grade on this next exam. Open books, open notes. Okay, how can you not make 100? I want to see a lot more hundreds. Join that gold club. People who make 100 on my exams, they're special people to me, and you can do it. Let's make it happen. And so with that, I'm going to share my screen and we'll get started here. All right. So I believe I have shared my screen now, and let's get back to where I want to be on this. You don't need this. This is where I want to be, right here. And so we'll move this down here, and we are going to talk about equity here. I wonder if I can move this around a little bit. You guys don't really need to see my face that much here. Okay. Again, as we start every chapter here, let's look at the end result. We're going to be measuring things again. We're going to be measuring equity transactions. But I never want you to forget what we're ultimately doing here is, not measuring. We're measuring with a purpose. We want to report to people how the business is doing, the income statement, and the status of the business at a point in time. What do the businesses own? And then what are the claims? Those are assets, things people own. What are the claims against those assets, liabilities, and equity? Don't forget, final exam is coming. Total assets equal the total of liabilities plus equity. Makes sense. All the things we own should equal all the claims against the things we own. And so we followed this course all the way through the balance sheet, all the way through cash and property, plant, and equipment, and we just finished up liabilities. And now we're in the final section. You are in the home stretch of this course, the last section of the balance sheet, equity. We will cover one last chapter, which is the cash flow statement next. But here, this chapter is about owner's equity. And so, and we've talked a lot about this, how businesses can fund themselves. They can either go out and borrow money, or they can sell ownership in the company to other people. Now, loaning money is great for owners because they, if the business booms and takes off, they only have to pay back what they borrowed. If the business doesn't do well, they won't be able to pay back they borrowed, and they'll go bankrupt. But the people who own the debt, like the bonds payable, we talked about in the last chapter, they don't get any upside. They just get their money back plus interest payments. Well, guess who gets the upside? All of the upside. Equity, owner's equity. And so companies and investors, like if you've watched Shark Tank with Mark Cuban and those guys, they're not going to loan money to these people who are coming with these business ideas. They want skin in the game. They want some equity. And so if the business takes off, and they'll probably try to help that business take off, they're going to get the upside. So owners own all the earnings of the company. And so owners want the company to do well. Now, we break equity into two parts. Paid in capital, which are these parts here, and retained earnings. There's some other elements we'll talk about here, but the two primary components of equity are paid in capital and secondly, retained earnings. What is paid in capital? That just represents amounts that people have invested in the business, the original amount of the investment. If people invested a couple $100,000, that 200,000 will be sitting here in equity. Now, if they take that 200,000 and they make lots of money, remember net income, that's going to flow into retained earnings. And so that second piece of equity is all the cumulative earnings the company's made over all time, less dividends paid out. And so this first lecture, I'm going to divide the equity lectures into two. We're going to come back and talk about retained earnings and dividends in the second lecture. In the first lecture, we're just going to talk about paid in capital. Common stock, that's the most basic form of ownership, for corporation. Some companies will also issue preferred stock as preferred because they have preferences. They have first rights for everything in liquidation, and they have preference over dividends. You cannot pay a common stock dividend until you've paid a preferred stock dividend. And you're going to see probably as you go through the Pearson lectures and even in the study plan, you'll see some questions and comments around preferred stock dividends. Just to let you know, we're not going to test on the preferred stock dividends. We're going to focus on common stock dividends, so you don't have to worry too much about that. But the thing you would have to know is common stock plus preferred stock. People are buying the preferred stock, giving the company money, plus additional paid in capital. We'll look at this in the journal entries in a minute. Those three elements make up what we call paid in capital. The next piece, again, retained earnings. And I repeat that a couple of times because I know that you're going to be tested on that. So let's look at the journal entries in a minute. Let's just assume, as an example, company sells 500,000 shares for $10 each. Some things you have to know also is the par value of the shares. This is a kind of a legal concept, par value. Really doesn't carry the same weight that it did in the old days legally. And so the main thing you have to know today is it affects the journal entries. And par value is usually set very low. And I think that helped in the older days. It's not as important these days what the par value is. But in the old days, there were some legal connotations in bankruptcy and other things. So you don't need to know any of that, but you have to know what the par value is so that you can do the journal entry. So how much cash did the company receive? So the cash received equals 500,000 times $10 each, and that's going to be equal to $5 million. So the company received $5 million and they issued, this is what sells or is also called issued 500,000 shares to people who now own ownership in the company. I don't let you know how many previous shares were on. I want to get into that here for this problem, but I want you to learn the journal entry. So in this journal entry, what's going to happen to cash? Cash is going to go up. What do we do with an asset when it increases? We debit that asset. So we're going to debit cash for $5 million. And we're going to credit the common stock account. This is the part, again, there are so many multiple choice on the issuance of shares. So I hope you really memorize this journal. It's actually easy. I think you could do really well in this next exam, especially if you're watching this video right now. You're going to have to know this. And so the only thing that goes in the common stock account is the par value times the number of shares. You could actually look at the common stock account, see how many dollars are in there, divide it by the par value, and you know how many shares are outstanding and how many shares have been issued. We'll get into outstanding in a minute. So common stock account, we're going to put 500,000 times $1, or $500,000. So again, the only thing that goes in the common stock account are shares times par value. That's the only thing that ever goes in there. So there's a credit. Here's the issue. While we received $5 million and we debited cash for $5 million and we credited common stock for $500,000, but the total paid in capital is $5 million. So we have to have another account. And guess what that's called? We are not creative with our names. We make it easy. Additional paid in capital. In other words, it's an addition to the par value. We've got $4.5 million. That's it, guys. Number one, if you know that journal entry, you're gonna pick up 3 or 4 multiple choice right away, and you won't have to spend any time on it because the math is easy. So you can get a real advantage in this next exam. Okay, the second entry I want you to think about. Let's say the company purchases. Let's do an amount. I'm going to say some of these shares. Let's say they purchase 100,000 shares of its own stock for $20 each. In other words, this stock price went up from 10 to 20, and now the company wants to go out and buy back some of the shares. It's a big thing. A lot of companies are buying back shares of their own stock right now. And what happens, they reduce the shares outstanding, which we'll talk about here in a few minutes. And so the earnings per share goes up because the earnings don't change, but the share counts went down. And so a lot of companies are trying to increase their earnings per share, which is a really important measure, by reducing the number of shares outstanding. And that's what's happened here. They bought 100,000 shares back. This entry is very easy. So guess what? The cash go up or down? Think about it for a minute. I'm going to pause. Think about it. They purchased the shares, so they had to pay cash. So credit cash for 100,000 times 20, or that's going to be $2 million, right? And here's a new term for you, treasury stock. And we just debit the treasury stock for $2 million. So we don't go back and change the common stock account. That's still sitting there, but we have another account that is a debit balance. Remember, equity increases with credits, right? And treasury stock is a debit balance. Therefore, a treasury stock is a reduction in equity. If you looked at, let's just look at an example. I'll just create one here on top of my head right off the bat here. Let's say you see a shareholders equity section, common stock, par value equals $1. And you see $1 million in that account, and you have additional paid in capital. Let's do it even bigger. Let's go make it big. 9 million. And let's say they don't have preferred stock, retained earnings. Let's just say, hey, this company's made a lot of money over time. Let's say it has 20 million of retained earnings, and they took those earnings and they bought back treasury stock. And let's just say they bought back $5 million of treasury stock. How much is in total equity? By the way, and let's just say they bought back 200,000 shares. And you're required to show the shares in common stock and in treasury stock when you issue an equity statement, a balance sheet with equity on it. And so how much would be in total equity? Well, you got 1 plus 9, 10, plus 20, 30. That's a minus. Treasury stock is a debit. That's a reduction in equity. So 10 plus 20, 30 minus 5, total equity equals 25 million. So you're going to have to know that treasury stock is a debit balance because those are shares we have bought back. By the way, how much is paid in capital? 10 million. We'll ignore treasury stock here. And how much is retained earnings? Easy, 20 million, right? So there's just some kind of definitions you're going to need to know for the exam. Paid in capital, retained earnings, and also you have to understand that treasury stock is a reduction in equity, a debit balance. Here's another thing you're going to have to know. Give me another pencil here. Some more definitions for you. Authorized shares, issued shares, and outstanding shares. Authorized shares is determined by the charter when the corporation got started. And let's just say for this count, this company, they had 10 million authorized shares. Means the board of directors is legally authorized to issue 10 million shares. How many have they issued though? Well, I can look at this. There's $1 million in the common stock account. The par value is $1. So I know that they've issued 1 million shares. Over time, they've issued 1 million shares. So they debited cash and they credited the common stock account over time for 1 million. So the only thing that shows up in the common stock account is the number of shares issued times the par value. So I take dollars divided by the par value and I know the shares issued. Now, that is not equal to the shares outstanding. What are the shares outstanding? I'm going to have to subtract the treasury stock, which was 200,000 shares. And so, I'm sorry. I'll do it differently. Excuse me. What are outstanding shares? That is issued shares minus shares repurchased, treasury shares. That's the definition for outstanding shares. Why do we do it this way? Important reason, treasury shares that are owned by the company, they've been bought back the company, they do not receive dividends, they cannot vote. And so they're just shares that have been removed from the marketplace. And so what we care about is outstanding shares, shares that can still vote, shares that will receive dividends. And that's why this definition is so important. So in this company, we have 1 million issued minus 200,000. So outstanding shares equal 800,000 shares. Authorized 10, issued 1 million in paid in capital, minus the shares we bought back, 800,000 outstanding shares. So this is an important definition. So if you don't understand this for the lecture, spend time on this. Now, there's one other thing that I want you to know, and that is earnings per share. This is an important profitability measure. And so the definition of earnings per share is net income minus preferred dividends. Because when we talk about earnings per share, we're only talking about it related to the common stockholders. They're the basic and the core owners of the business. So I take net income minus preferred dividends divided by outstanding, the number of, let's do it that way, number of outstanding shares of common stock. So pretty easy math here. Let's say the company made $1 million and they paid preferred dividends of 100,000, and they had outstanding shares, 450,000 outstanding shares, and it's a weighted average throughout the year. We won't get into that. So my answer would be 1 million. That'd be 900,000 divided by 450,000 equals to $2. So my earnings per share equals $2. This metric really matters. It's the only ratio, we talk about a lot of ratios in the class, that is required to be included on the face of the income statement. And so analysts at Wall Street, people following, tracking the company, they're highly focused on earnings per share. So when I know the net income per share, the earnings per share, I can compare it to the price of the stock per share on the New York Stock Exchange. And I can create multiples. That's called the PE ratio. And that tells me whether my stock is an expensive stock, overpriced, or a cheap stock. So this earnings per share, you don't need to know the PE ratio and all that, but I'm just letting you why it's so important. But you need to be able to calculate the earnings per share. So with that, let's come over here, and I'm hoping that you can see all this. Let's go work a problem. And so the problem is here. LSA Burger, my favorite restaurant in Texas, probably maybe in the United States. I love LSA Burger in downtown Denton. I'm sure they're closed down now. I haven't been up to the square much. So LSA Burger had the following transactions. They issued 1 million shares for $50 per share. The par value was $1. And then later they came back and repurchased 10,000 shares for $60 per share. So what I'd ask you to do, pause the video right now, go work that problem, and then you come back, restart the video, I'll work the problem, and we'll see how you did. All right, hopefully you got this right. So here we are. They issued 1 million shares. And they sold them, issued them for $50 per share. Par value equals $1. So how much cash did they receive? They sold 1 million shares times 50 each, so they got $50 million. So debit cash for 50 million, and credit common stock account. What do we put in the common stock account? Every day, every hour of every day, every month, shares times the par value. So 1 million times $1, 1 million. And the leftover, 50 minus 1 million, we put it in additional paid in capital. How much? Whatever's left over. 50 minus 1, 49 million. That easy, folks. Now on June 30th, so this is January 1, on June 30th, they bought back some of these shares. They bought back 10,000 shares, so repurchased. $10,000 shares times $60 per share. So the shares have gone up. How much cash did they use? So it would be $600,000 in cash, right? 60 times 10,000, 600,000. Well, that's a reduction in cash. So let's just do that first of all. 600,000, and we debit treasury stock for 600,000. Guys, it's that easy. You are going to just rock and roll on this. Let me see. I want to do just 2 more. I know we cannot do reef pollings here like this, but reef polling question number 5. Take a look at this. Hopefully you can see this up on the screen there. Can you work it? Pause the video if you need to. All right. Authorized shares equals 50 million. Issued shares. Well, issued shares, I'm going to have to do some calculation here because it's a $1 par value. So it's a dollars in common stock account divided by par value, right? Because the only thing we put in the common stock account is the shares times the par value. So if we want to know how many shares we have, simple algebra, dollars in common stock divided by the par value. So we have $10 million divided by par value of $1. So I've got 10 million shares. So issued shares equals 10 million. All right. How much have I repurchased? Repurchased treasury stock or repurchased shares equals 5 million. So that's 5 million shares. They no longer receive dividends. They no longer can vote. They have no. It's just sitting in the in the lockbox, sitting there in the Treasury Department in the company. That's why I guess we call it treasury stock. So outstanding shares means shares owned by people outside of the company equals 10 million minus 5 million. 5 million. Answer A. All right. All right. Which of the following accounts would be considered paid in capital? You can pause the video and think about this for a minute. All right. Guess what? Common stock, they paid in money to purchase common stock for the company. The company received money. Preferred stock also sold by the company. And we already know additional paid in capital are amounts paid in above the par value. And I guess you should know that because it's called the paid in capital, additional paid in capital. It's got to be part of the paid in capital. We're not too tricky on the way we name things. So A is paid in capital, common stock. B, preferred stock is paid in capital. C, additional paid in capital is paid in capital. So the answer is E. All of these would be considered paid in capital. And then the last one we'll do here before I do the dividend lecture, which will be in a separate lecture, how much is the earnings per share given the following information? So I'll pause here and you pause the video. I'll pause just briefly here. Pause the video, work this, and then come back and we'll talk about it. All right. So this one's a little harder because I got to calculate the average shares that are outstanding. Now the top part, let me just do this here differently so we have more room here. So here I can write here. Net income minus preferred dividends divided by average outstanding shares. So we're given the net income of 500,000. So this part is easy. That's 500,000 minus 100,000. Here's the hard part of this problem. What are the average outstanding shares? So beginning of year, BOY, is 1,000,000 shares issued, and then treasury stock. And so let's see, so beginning of the year was 1,000,000 and we had 500,000. So beginning of the year, we had outstanding shares of 500,000. At the end of the year, we had 1.5 million issued and only 300,000 treasury stock outstanding, 1,000,002. Therefore, average would be beginning of the year plus end of year divided by 2. 0.5 plus 1.2 divided by 2. So 1.7 divided by 2, or 850,000 shares. So you got that 1,000,007 divided by 2, 850,000 shares. No dollars on that, just the shares. So now we just calculate the formula here. We've got 500,000 minus 100,000 divided by 850,000. So that's going to be equal 400,000 divided by 850,000. My old trusty calculator out here. $0.47 per share. Answer C, 47 cents per share. Okay, guys, that's it for the lecture on issuing common stock. It's not it for this chapter because I'm still going to cover dividends in the next lecture that you can see, and I divided it up a little bit to make these lectures a little bit shorter. So thank you for listening. We will talk to you shortly. Bye.